How to buy farmland. No, I am not talking about becoming a farmer and purchasing a property, but investing in the idea that farmland is a finite supply and is actually a deflationary asset because the good land is actually shrinking. What's the story with farmland investing? We all know that farmland is a great hedge against inflation and a diversifier for your portfolio, and available to investors like you and me via the tickers FPI and LAND. But how have these two REITs performed this year during record inflation, and what's on the horizon in the coming years? I'm Skylar James. Welcome back to the channel. In case you wonder where I'm filming from, the background is downtown San Miguel de Allende. It is Travel and Leisure's #1 rated city in the world, and this place is absolutely amazing. I'll include a few pictures at the end to show you its stunning beauty and architecture in case you want to virtually visit here. Let's go back to farmland. Remember that it has similarities to carbon allowances, another unknown investing niche that I love. It's similar because it hasn't always been easy for average Joe investors like me and you to invest in. But even as farmland has become investable in the last few years, it's still a relative unknown. Even so, Farmland Partners, ticker FPI, is up 40% this year, and Gladstone Land, ticker LAND, is up 130%. Billionaires like Bill Gates have been piling into farmland long before 2021. In fact, Bill and his ex-wife Melinda collectively own over 200,000 acres of fertile soil. But why is farmland a better real estate investment than, say, warehouses or doctor's offices or luxury apartments? It all goes back to the human population thesis that the population of the planet increases by over 200,000 each and every day, and all of those people rely on food 3 times a day. Farmers, therefore, have an unlimited demand for their products. At the same time as demand for their products increases, the amount of arable land decreases at a predictable pace. Arable land is land suitable for farming. This loss of arable land is generally the result of human-caused problems. You have climate change, soil erosion, or just plain old bad management practices. Whatever the factor, it's these two reasons, increased demand and shrinking supply, driving up farmland prices. On top of that, companies like Gladstone and Farmland Partners then lease out their farmland to farmers and retain a percentage of the crop sold. Most of the company profits are then piled together and passed on to us, the shareholders, as legally required by REITs. If you haven't put this together before, this is the reason why it isn't crazy to see REITs paying out 6, 7, even 8% dividend yields. It's part of their legal structure. Investors therefore tend to put a lot of weight into what kind of dividend a REIT pays out. So I know your next question is, what's the dividend of Farmland Partners and Gladstone Land? It's not great, at least when compared to the REIT universe as a whole. FPI is paying out 1.66% as I record this, and Gladstone is paying out 1.63%. Gladstone is a little bit special in that it pays out that dividend monthly. What I like about Gladstone is their focus on high value crops with low price volatility and dependable rent income. I also like that they've grown their revenue 40% year over year. But maybe what Gladstone is doing best is buying up the highest value land. Check out the map of their holdings. California contains about 40% of the company's farms, and California farmland is gaining value at an incredible pace. Think about it. Lots of sunshine, warmish winters mean a long growing season for farmers. Combine that with information here, Gladstone estimates that their annual fresh row crops have a market value of $15 billion across 3,000 farms. Buried down below with this little asterisk is that Gladstone is estimating their farms fall in top 10 to 25% of farms in those categories, meaning Gladstone is serious about getting performance from their farms. This isn't just throwing some seeds in the ground and hoping for rain. This is efficient, industrialized farming. Farmland Partners is skewing their farming portfolio in a different direction. About 70% of what Farmland Partners grows is primary crops. You have corn, wheat, soy, lower value crops. And the other 30% taps into the higher value items like almonds and blueberries. And these primary crops have longer shelf lives and are capable of being shipped long distances to places like China. Farmland Partners has been feverishly adding more farmland to its portfolio. Just in the last 2 months, they purchased 800 acres of Missouri farmland to grow rice, corn, and soybean, 1,200 acres for corn in Colorado, 166 acres of citrus in California, and 8,000 acres for corn and other crops in Louisiana. Now, this is how your money is growing as an investor. Farmland Partners adds new farms into its portfolio. It rents the farmland out and shares in the profits of the crops, all while good old-fashioned inflation increases the value of farmland and good food being grown. So what are the downsides? I'm not sure how else to put this except these farmland REITs are exposed. Like when you hear of somebody getting lost in the woods, they might be suffering from exposure. Farmland is exposed. It's exposed to droughts, water conflict, heat waves, brush fires, labor shortages, chemical shortages, shipping shortages, supply chain slowdown. Farms are delicate 12-month cycles that can't handle a rough week at any point in the process, meaning that a particularly bad case of one of these situations I just mentioned could ruin a year's worth of farmland profits. It's easy for me and you and non-farmers to sit around and think that droughts lead to higher crop prices, which could lead to more profits. And for farmers, right? And sometimes, in some ways, yes, that's true. But droughts can also mean unhealthy plants, plants that struggle to reach harvest stage, plants that don't qualify for that top 10 to 25% of farms that we talked about. Water shortages don't lead to the best plants, produce, or crop. Diversity can alleviate some of that risk for us as investors. Farmland Partners owns over 150,000 acres across 16 states, growing 26 crops. The numbers for Gladstone Land are similar, 160-ish farms on over 100,000 acres across 15 states. And owning both of these REITs would hedge you against being too centered on either primary crops or high-valued ones. Ultimately, farmland is a good investment, but is hard to access for the average person. These two REITs solve that. They give us diverse holdings and are a proven inflation hedge. I would expect them to continue being volatile in the near term, but I love their potential over the long haul. Thanks for watching, and I'll see you on the next one.